Good afternoon, everybody. Welcome to my video update. Today is Tuesday, July 2nd, 2013. One thing I just want to talk about a couple of things today. I know you've got your statements. There's been concerns that we were down a couple of percent in June, and there's several reasons for that, and I just wanted to make sure that everybody knows where we're coming from and where we stand. The first thing is U.S. stocks were down. They were down about 3% on the month. But more importantly, and a much bigger deal, is the bond market. In June, really, the bond market had its worst month since 1994. And in 1994, there was a crisis in the bond market. What happened here in the U.S. and worldwide this month was the Federal Reserve talked about an improving economy, and they might start to taper off, which on their quantitative easing, which is going to allow interest rates to rise. Now, the effect of that meant that municipal bonds fell about 10% last month. International bonds fell about 15%. U.S. Treasuries fell about 7% last month. Now, these are huge moves for 1 month in the bond market, but it's an example of how dependent the markets have become on the quantitative easing. Other things like real estate funds, REITs, or home builder stocks really got pummeled last month because a rising interest rate environment means you just can't finance as much house. On top of that, utilities, things that are known as safer plays that pay a dividend, well, they got crushed last month, down about 9%. These are things that, fortunately, we didn't have any losses anywhere near that, but our portfolios this year have been really concentrated in the dividend-paying areas and more in the bond markets. Fortunately, we got out of the bond market earlier in the year. I put a little bit back to work, but we were forced to sell some of it, and I'm glad we sold it because the losses would have been much more extreme. The good news is we now have a much better buying opportunity, especially when it comes to U.S. bonds in the corporate sector and international. These have really gotten beat up, and they look like they're starting to show some support. And believe it or not, we'd actually be buying back into these levels that we bought back in, that we originally bought back in late 2011. So I mean, that just, I'm going to show you a couple slides. I'm going to attach a couple slides here to show you how fast and violent the moves were in the bond market over the last month, and they really gave back almost 2 years of gains in 5 weeks. And but now, if it looks like it is closer to the bottom, I mean, the economy is clearly not strong enough for the Federal Reserve to stop the tapering, and I think interest rates are going to stay here for a while. That chase for yield will begin, and we're going to just get back in at a better area. I know there was a little shock when we saw these statements, down a couple percent. I wish I was perfect and I could have avoided it, but it's, in investing, I mean, the market does go up and down, and when you see a quick shock like this, it's definitely going to, affect the accounts. But as you know, I mean, I did make some moves last month to protect you as best I can, and I'm looking forward to putting that money to work and earning that 3% back as quickly as possible. With that, please, if you have any questions, give me a call, and have a wonderful 4th of July, and I will be in touch with you soon. Have a great day.